Most people think they've handled the big financial disasters. They've got some savings, maybe life insurance, maybe coverage through work, and that feels like protection. But for most working adults, the financial risk they're most likely to face is the one their protection plan handles worst. In this video, I want to show you where that protection usually breaks down, what the income shortfall can actually look like when you run the numbers, and why closing that gap is often more straightforward than people assume. Think about what your income actually is. Not a salary number on a contract, not a direct deposit every 2 weeks. It's the engine that runs your entire financial life. The mortgage gets paid because of it. Retirement contributions happen because of it. The emergency fund gets built because of it. Investments compound because of it. Every calculation you've made about your financial future, the debt payoff timeline, the retirement date, the savings rate target, all of it runs on one assumption: that the income keeps arriving. Now look at what most people have insured. The car is covered because the law requires it. The house is covered because the lender requires it. Health insurance handles medical costs. And for most adults, at some point, a life insurance policy gets purchased to make sure that if something happens to them, the people depending on them aren't left without resources. All of that is correct, but notice what's missing from that list. We've insured the assets, we've insured against death. And the one thing generating all of it, the income itself, is, for the majority of working adults, completely unprotected. Most people have never directly insured their income. They've insured everything it pays for. The Social Security Administration publishes long-run probability data for insured workers. Here's what it shows. Roughly 25% of today's 20-year-olds will experience a disabling condition before they reach retirement age. The probability of dying before retirement is about 13%. That means you're approximately twice as likely to become disabled during your working years as you are to die during them. That's the probability inversion most people have never seen before, and it's the one their financial protection is built backwards around. The consequences aren't abstract. The average disability claim lasts 34.6 months, just under 3 years. During that entire window, nothing in your financial life pauses. The mortgage doesn't pause. The car payment doesn't pause. Debt keeps accumulating interest. And if you look at what actually puts people in foreclosure, the data is stark. Disability accounts for 48% of home foreclosures in the United States. Death accounts for 3%. Most people have insured the 3% event. Most people have not insured the 48% one. So what are most working adults actually relying on? There are 3 layers of protection most people assume are covering them. Let me walk you through what each one actually delivers. The first is Social Security Disability Insurance, SSDI. This is the government program that exists specifically for this scenario. Here's what it actually pays. The average monthly benefit in 2026 is $1,630. For someone earning $73,000 a year, that's less than 27 cents on the dollar. Getting there isn't straightforward either. The SSA initially denies about 62% of applications. If you appeal, the process extends by another year or more, and from initial application to final approved decision, the timeline can reach close to 3 years. Almost exactly as long as the average disability claim itself. The program wasn't designed to replace working income. It was designed to provide a floor, and for most working adults, that floor is far lower than they've ever calculated. The second layer is employer group coverage. If you have long-term disability insurance through work, you probably feel reasonably protected. But here's what most people don't know about their own policy. Group LTD plans cover 60% of your base salary, not your total compensation. Bonuses, commissions, and variable pay are excluded. If your employer pays the premium, which most do, the benefit is taxable when you receive it. After tax, that 60% replacement often lands at 38 to 42% of your real income. And many group policies include an SSDI offset clause. Whatever the government program pays, your employer plan reduces its benefit by the same amount. You don't stack them, you get one, reduced by the other. There's also a practical issue most people overlook. Group coverage is tied to your employment. If a long-term disability forces you out of that specific job, the policy doesn't travel with you. And the third layer is life insurance, which, as we've established, addresses the less probable outcome. None of this is worthless. SSDI is better than nothing. Group LTD softens the blow, but the combined picture most people are relying on has a gap much wider than they've ever calculated, and that gap is where financial lives quietly unravel. Let me show you what this looks like in practice. Rachel is 36, a marketing manager earning $73,200 a year, no individual disability coverage. She's diagnosed with an autoimmune condition and can't work for 19 months. The SSDI application takes 6 months to process, during which she receives nothing. She gets approved at $1,847 a month. Her actual monthly income had been $6,100. The shortfall is $4,253 every single month. Her emergency fund was $11,000, gone by month 2. Over 19 months, the total income gap reaches $91,889. Now consider Marcus, 42, a regional sales director. Base salary, $89,400. Annual bonus, $27,600. He has long-term disability coverage through his employer and figures he's protected. A back injury keeps him out of work for 30 months. The group plan covers 60% of base, $4,470 a month gross. The premiums were employer paid, so the benefit is taxable. After tax, he nets roughly $3,612 a month. His pre-disability monthly income had been $9,750. The gap is $6,138 every month. Over 30 months, that's $184,140 in uncompensated income from a policy he believed was protecting him. Here's how I think about evaluating your own situation. There are 2 questions worth answering honestly before you assume you're adequately covered. The first is, what is my actual income replacement number? Not the headline percentage. What arrives in your account after tax, after bonus exclusions, after any SSD? I offset your group plan applies. For most people, that calculation has never been done. When they do it, the number is significantly lower than they assumed. The second is, what does it cost to close the gap? Individual long-term disability insurance, with an own occupation definition, a 60-day elimination period, and benefits running to age 65, is more affordable than most people expect. For a 38-year-old, a policy covering $5,500 a month typically costs in the range of $150 to $180 a month. That's roughly $2,076 a year. For comparison, many people are paying $1,340 a year or more for life insurance to protect against the event with approximately half the probability. The own occupation definition is the one term worth understanding. It means you qualify if you can no longer perform your specific occupation, not simply if you're unable to work at anything. A surgeon with a permanent hand injury qualifies under own occupation even if they could technically do other work. That distinction is often the difference between a policy that pays and one that finds a reason not to. As for the coverage level, you don't need to replace your entire income. You need enough monthly replacement to cover your fixed obligations or mortgage or rent, debt payments, the baseline your household requires, until you can return to work or your savings can absorb the rest. That's the floor. Start there. Here's the thing about financial protection. Most of us build it around the assets we can see. The house, the car, the portfolio, the life we've built, and the people depending on it. We insure what we've accumulated. We rarely insure the process that created what we've accumulated. Your income isn't guaranteed by your employer. It isn't guaranteed by the government. It isn't secured by your own good health. And the most probable financial disruption in a working adult's life, more likely than a house fire, more statistically certain than dying too soon, is an extended period where that income simply stops. Most people have insured the 3% event. They've done it deliberately, thoughtfully, and correctly. They just haven't applied the same logic to the event that's nearly 4 times as likely to actually happen. That's the protection gap. It's worth closing. If you found this useful, subscribe. We put out one of these every week. And if you want to think through the cash buffer side of this, how much liquid runway you actually need before a disruption like this becomes survivable, that video is worth watching next.